Now we are going to discuss about principles of insurance. Insurance means protection against risk of life. It is a device of providing protection against risk. Business is full of risks and uncertainties. A businessman wants to carry on his business free from risks and uncertainties. An insurance company specializes in providing protection against certain risks and uncertainties. This protection is provided by distributing the risk of loss of few among many persons in consideration of a premium. The insurance company agrees to give full compensation to the insured against any actual loss or damage caused to him involved in the business. For the premium, the amount of premium depends on the nature of insurance policy along with the risk covered. Anybody can transfer the risk to the insurance company by entering into contract of insurance. Certain principles are utmost good faith. Insurance contracts are based upon mutual trust and confidence between the insurer and insured. Hence, they are said to be uberma fides, that is, of the utmost good faith. Insured should display. It's a basic condition of every contract of insurance that the insurer and insured should display utmost good faith towards each other in regard to the contract. In other words, each party must reveal to the other party all information which would influence the other party's decision to enter into contract, whether such information is asked for or not. Principle of insurable interest. It requires insured must have an insurable interest in the subject matter of insurance. The insured must be so situated with regard to the subject insured that he would benefit from its existence and lose from its destruction. Without insurable interest, the contract will be a gambling policy, not a valid in the eyes of law. For example, a creditor has an insurable interest in his debtor. A wife has an insurable interest in the life of her husband. An employer has insurable interest in the life of his worker. Now, principle of indemnity. Insurer undertakes to compensate the insured for the loss caused to him by the damage or destruction of the property insured. The compensation payable and the loss suffered are to be measured in terms of money. This principle is applicable in case of fire, marine insurance only. It is not applicable in case of life, personal accident, sickness insurance. Now, principle of contribution. It is a corollary of the doctrine of indemnity. It applies to any insurance which is a contract of indemnity. A particular property may be insured with two or more insurers against the same risk. In such cases, the insurers must share the burden of payment in proportion to the amount assured by each. However, a policyholder is not entitled to claim from each insurer more than the rateable proportion of loss to which one is liable. Principle of subrogation. After the insured is compensated for the loss caused by the damages to the property insured by him, the right of ownership of such property passes to the insurer. If the damaged property has any value left or the lost property is recovered, that cannot be allowed to remain with the insured. Principle of causa proxima. That means insurer is liable for loss only when such loss is proximately caused by the peril insured against. If the risk insured is the remote cause of loss, then the insurer is not bound to pay compensation. It has been defined as the active and efficient cause that sets in motion a train of events which brings about a result without the intervention of any offense started and working actively from a new and independent source.